What's up, everyone? It's Ben here, and today we're going to go through another fun topic, which is income statements for beginners. And let me go through today's agenda, which is pretty simple. First of all, we're going to go over what is the income statement, then the core components of the income statement, which are revenue, COGS, expenses, and profits. And then lastly, we're going to go through some easy Excel examples so we can really hammer the concepts we go through together here. And I also wanted to remind you guys that the Excel and this PowerPoint is going to be available down in my description below for free to download and also as a pinned comment. So let's just jump straight into it. First of all, what is the income statement? So the income statement is one of three core financial statements. And this video right now is part of a multi-video series where I'm going to go through each of these. And my previous video was on the balance sheet. So feel free to check that out if you haven't already. So the income statement can be defined as a financial statement that reports a company's revenue, costs, expenses, and profits or losses over a period of time. And one part I want to focus on here is the period of time part. So that's different from the balance sheet, let's say, which is just a snapshot in time, versus the income statement, which is over a period of time. And when we go through the Excel, you'll kind of see what I mean. So let's go through some of the key core components that are listed in this definition. First of all, revenue, money generated from the sales of goods and services. Pretty, I think, intuitive and self-explanatory. Then you subtract out your COGS, which stands for your cost of goods sold. And these are direct costs of producing goods and services. Then you subtract out your expenses, which are the operational costs that help maintain the business. And that leads you to your profit, also known as your net income. And this is money remaining after all costs and expenses are paid. This is different from something like actually having cash flow, which we'll go through in the next video of like cash flow statement and all that. And each of these components also are a little bit more complicated than, what I've written here, but that's what we're going to go through throughout the rest of this video. So just as a quick summary, the income statement describes how much a company earns, spends, and profits. Before we move on to the next part of the presentation, I want to talk a little bit about Wall Street Prep, who is today's sponsor for the video. And they provide a lot of really great financial modeling and finance courses. And they teach everyone all the way from the top investment banks for analyst training, all the way to university clients. I'm currently getting my MBA at Wharton, and a lot of my classmates are actually using the Wall Street Prep program. And if you look through their courses, they have a ton of different courses, pretty much anything in finance that you want to learn about when it comes to like modeling or corporate restructuring, accounting, etc. Pretty much Wall Street Prep will have. And two courses I in particular recommend are the accounting crash course. If you're totally new to accounting totally new to finance, accounting is the language for finance. So recommend this course if you don't really have much of a background in finance. And if you want to learn just more about financial modeling and valuation in general, I really highly recommend their premium course. There's over like 100,000 students who have taken this course. And you'll learn everything that I learned at JP Morgan, such as financial statement modeling, DCFs, M&A modeling, trading comps, transaction comps, LBO modeling, and more. And if you use my code RareLiquid, you'll get 20% off. So make sure to do that. Everything is linked down in my description below. Feel free to check them out if you're interested. All right, with that said, let me now go into the core components of the income statement, which are revenue, COGS, expenses, and profits. So revenue is generally thought of as price times quantity. So if, let's say, you are selling t-shirts at $10 per unit and you're selling them for $10 each and you sell 100, then that's $1,000 in revenue, right? Things do get a little bit more complicated where there's a lot of classifications and different ways you can look at revenue, especially if you have a really, really big company. So on the left-hand side here, we can see the core business activities and operating revenues. And so there's a lot of different ways you can kind of segment revenue, right? You can look at the different types of products, like Apple might have different revenue segments for their iPad and iPhone, and they also have different types of all those devices, right? So things could get really complicated. You could do it by geography, subsidiary, sales channels. And so that's kind of like your operating revenue. This is really the major component of revenues. But you also have non-operating revenues, which kind of relate to non-core business activities, such as interest income, rent income, partnership, other income. I wouldn't really worry about this too much. Like I said, the operating revenues is the bulk of most companies' revenues. Probably like this is roughly 90% or more, 90 or 99% really. So that's revenue. I think most people kind of understand what revenue is. Next, we have your cost of goods sold, also known as your COGS. And this is generally kind of thought of as your cost times quantity, which similar to t-shirts, if it costs you $5 to make each and you sold 100, then that's 5 times 100, which is $500 of COGS. So there are also several classifications for COGS, and you can think of them in terms of things like raw materials, labor, packaging, depreciation, which is a slightly more kind of intermediate accounting concept I won't go through today. But I think hopefully this example makes sense. And throughout everything that I go through in this section will reinforce with the Excel as well. So after our COGS, we get our operating and non-operating expenses. And these are expenses that are used to kind of maintain the operations of a business. Again, similar to revenue, your operating expenses are going to be primarily the bulk of your expenses. And these include things like your selling, general and administrative, research and development, marketing, and other operating expenses. And then you have non-operating expenses, which are things like interest payments, losses on assets, one-time costs, lawsuits. So these are things that just kind of happen almost, or they're non-reoccurring and can almost happen at random at times. And so, like I said, the bulk of your operating expenses will come from your primary operational activities, and these are the ones that are recurring and the line items you'd really want to look at. So next are profits, right? And so these can be broken down into gross profits, operating profit, and net profit. So gross profit is your revenue minus your cost of goods sold. Your operating income, also known as your operating profit or EBIT, which stands for earnings before interest and taxes. That's simply your gross profit minus your operating expenses. Then you have your net income, also known as your profit, and that's your operating income or EBIT minus your interest and taxes. So a lot of people use the word profit, and I know we just went through 3 different types in a sense, but when people say like the profitability of a company, or at least in the finance world, it's generally they're generally talking about the net income. So I just wanted to kind of highlight that. For everything else, they'll call it gross profit or EBIT or operating income. Net income is usually what they say when they talk about the profitability of a company. Profits are also commonly expressed in margins, and this is a kind of side topic in a sense, but I think it is very important because it kind of helps you margins help provide insight on the operational efficiency of a company, and you'll see that when we go through the Excel. But gross margin is gross profit divided by revenue, EBIT margin, operating income divided by revenue, profit margin, net income divided by revenue. Really simple stuff that you kind of just need to memorize. And so here's what I would say is a kind of graphic of the core components of what the income statement looks like. So you start off with your revenue, then you subtract out your cost of goods sold, which gets you to your gross profit. Then you subtract out your operating expenses, which get you to your EBIT or operating income. Then you subtract your interest and taxes. That gets you to your net income, which is your bottom line. So people say, what's the top line of a company? What's the bottom line? This is pretty much what they're referring to here. And here's another graphic that, it's pretty much the same thing, but I think is a good way to kind of see how the kind of everything kind of like decreases as you keep paying your costs, right? So you have your revenue here, then you subtract out your costs of goods sold, your operating expenses, your interest and taxes, and that gets you to your net income. And you're typically going to see this happen a lot where you might have a ton of revenue, but it doesn't really mean that much unless you are actually profitable, right? So another kind of like graphic I wanted to share here. And now let's go into the Excel examples, which as a friendly reminder is available to download for free. So this Excel is actually going to kind of build on top of the previous balance sheet Excel that we did in the past. And after I do each of the 3 core financial statements, I want to tie everything together to kind of show you how all 3 financial statements kind of work together. So that's why I did it like this. But if you remember from the previous video, if you watched it, we started a lemonade stand, which we're just calling Lemonade Co. And there are 4 different kind of events that have happened, I guess, over the past first few months of the year. And so we're going to try to basically create a income statement based on these 4 activities. So first off, what happened in January 15th is that you bought some supplies for your lemonade and you paid $500 for them. And so let's see, I kind of preloaded what happens to each of the course key segments here. So revenue doesn't change. COGS increases by $500. Operating expenses, interest and taxes, nothing changes. But you'll notice here that our income statements is as of January 1st, where nothing has happened, and then to January 31st, right? So we can put in our cost of goods sold minus 500. But we actually need to see what happened in January 31st to get our full income statement, which, as you can see here, is that we sold out of our inventory completely and generated $1,000 in revenue and $500 in profit. So let's see what happens here. The revenue increases by $1,000. COGS we already have in there, operating expenses and interest and taxes. So lemonade sales increases by $1,000. Gross profit margin, something we can calculate, which is our gross profit divided by our revenue. Same thing for operating income, operating income margin, and then profit margin. And you'll pretty much never see these three all being the same, and they'll be different by the end of the video, but I just kind of wanted to run through this like example with you guys doing that so you have some practice calculating margins. So the next thing we need to do is just figure out what our income statement looks like as of the end of January 31st. So all we need to do is get our beginning, which is pretty much at 0, and then add up the change. And for the margins, it'll be the same thing, which, this will be a little bit repetitive right here, but I think it's good practice if this is your first time just calculating margins. All right, so the next thing is after 1 month has passed, you see your success and you're like, wow, I can create the best lemonade company in the world. So you spend $50 on Facebook ads to increase traffic towards your lemonade stand. You hire your little brother and pay him $100. And then you sell $2,000 worth of lemonade, which cost $700 in supplies. So let's see what happens here across your core segments. So revenue increases by $2,000, COGS increases by $700, marketing increases by $50, and wages by $100. So the changes here are $2,000 for revenue, cost of goods sold, $700. Your margin for your activity so far this year or that month is 65%, because you'll notice that if we were to just double the 500 previously, it would have been $1,000 based on like 2xing your sales. But let's just, for example, say that with kind of more economies of scale, you're able to negotiate better prices with your suppliers. And then for marketing, there's a $50 cost here, and then your wages to your little brother. And you can see also here as well that your operating income margin has increased as well. So this is just something I wanted to point out, where if you're growing as a company, typically you should be increasing your margins over time, just because you become better operators, managers, have more negotiation power and all that. So you'll also, but for our net income, since we have no interest and taxes, it'll just be the same. So as of February 28th, 2022, let's see what everything looks like here. So you can see that your gross profit margin has improved, as will your operating income margin. And then no interest or taxes yet, so this will be the same as your operating income or EBIT margin. All right, so last up, at the end of March, you take a break and you don't work at all because you're tired, you have school, whatever. But you do have to pay $5 in interest from a $250 loan that you took out earlier from your parents, and you need to pay quarterly taxes on it. And you also need to pay taxes. You have to pay $5 on the interest, and then you also have to pay quarterly taxes at a rate of 20%. So let's see what happens here for the key parts of your income statement. Oops. Right. All right. So nothing happens to the three sections here, but for interest and taxes, interest goes up by $5, and then your taxes are paid at 20% of EBT, which is your earnings before taxes. I'll walk you through how that works. So let's see what happens to the income statement. Your change here in your interest is negative $5. And then for your taxes, what we need to do here is going to be something a little bit new, but we want this to be a negative number. And then we're going to do 20% and multiply this by our EBIT, or operating income. And we're going to actually plus our taxes here because the tax is a negative number. And then we're going to press enter. And that'll get us to our tax figure. So next, what we want to do is just look at the previous amount and then add our change. And that'll get us to our net income as of March 31st, 2022. And as you'll see, our profitability will have gone down because we just paid some interest and taxes. So there you go. You get your first lesson as to why everyone kind of hates taxes, because you have to pay a huge amount to the government every time you make some money. And so, I know I went through this kind of quickly. I do recommend maybe like going through this maybe 1 or 2 times extra if any of this was kind of new to you. But that might be also a good segue into the concluding thoughts that I had for this video, which first of all is that financial statements report a company's revenue, costs, expenses, and profits over a period of time. Hopefully by now that's like really ingrained in your head, especially if you've been doing the Excel. And something that I just think is very important to memorize is the income statement core line items, which is your revenue minus your cost of goods sold, which gets you to your gross profit. Then you subtract out your operating expenses, which gets you to your EBIT. And then you subtract out your interest and taxes, which get you to your profit. So something that I think if you're in finance, you just really need to memorize. And then lastly, understanding the income statement does take time. And the best way to learn is to study each line item and see the role that they play in the income statement. And kind of like play around with the Excel that I created and hopefully that you worked on to see how everything works. And lastly, just some reminders. Excel and PowerPoint can be downloaded for free down in the description and pinned comment below. And you can also sign up for my upcoming investment banking recruiting course for a huge discount. I'm giving a big discount to people who sign up early. And lastly, if you want to learn more about like financial modeling, check out Wall Street Prep for a really in-depth list of courses where you can just learn a ton about financial modeling and a whole lot more. So with that said, I hope this was helpful. If you want to learn more about the balance sheet, check out my previous video, and my next video will be about the cash flow statement. That said, thank you all so much for watching and hope to catch you in the next video. Thanks guys, and peace out.